Welcome back to the channel. A lot to talk about this week, a lot to share opinions and thoughts on, especially as it comes to fixed rate mortgages, what's sort of happening right now. What do we see as these bond yields continue to push upwards and onwards? And what does it mean for Canadians looking to get into the real estate market, especially as we head into June 25th? Will we see more inventory hit the market as investors maybe unload some of these properties? And what will happen after June 25th? What do we see sort of happening right now on the ground floor? So want to take an opportunity to cover some of those thoughts this week. And we welcome you back to the channel. It is Friday, Finance Fridays. I'm your host, Anthony with In Touch Mortgage Solutions. And if you have not subscribed to the channel, we invite you to go ahead and do so. Don't forget to hit that notification bell so you get notified every time we post a new video. And don't forget to leave your questions and comments, thoughts in the comments section below, and we will answer them in a future episode. So I want to take an opportunity to kick things off by talking a little bit about the fixed rate mortgage environment. And we will be doing a mortgage update on those particular rates as we sort of see where things are going. But there hasn't really been much movement in some of these posted rates. We have definitely seen some fixed rate mortgages go up depending on the product, if it's a 3 or 5 year. We've definitely seen some movement. Some of the smaller broker-friendly banks, what we call the monoline lenders, they have definitely moved up some of the 3-year products. They are reducing some of the discounts on those 5-year products, but they're anywhere from 10 to 15 basis points. Ultimately, we see how things will play out over the next little while as these bonds, the 5-year Bank of Canada bond, for example, the barometer for how fixed rate mortgages and loans are priced, are starting to tick back up to high levels. And this ultimately means that we could see some fixed rate mortgages potentially move. Now, when it comes to some of the major banks and major players in the space, remember, top 5 banks control over 85% of the mortgages. We definitely have access to those particular products. We've been talking with a few of our lenders, and ultimately they have a posted rate, what they're holding on that rate hold for that pre-approval for 120 days. And what's happening right now is we were able to send in rate requests and obviously ask for a discount on the live deal. So they would go to the powers that make these decisions behind closed doors. They would analyze what's happening in the bond market. They'd say, hey, this is the posted rate. Based on the bond prices, we can give a discount to this rate. And this is what's sort of happening. But over the last little while, what we're noticing now with some of our clients is we're not getting the significant discount anymore, right? We weren't getting some of those 30 or 40 basis points off the posted rate or the contract rate that the pre-approval was being held at. So as these bond prices continue to wreak havoc on fixed rate mortgages, many Canadians have this little bit of a disconnect between, fixed rate and variable rate mortgages. How are they priced? And, for some Canadians that are looking at the Bank of Canada, which is obviously the leading indicator for what's happening with primarily variable rate mortgage. I think this is the best way to put it. I mean, ultimately there's other implications if the Bank of Canada cuts, maybe in shorter term fixed rate mortgages, but it's going to be a lot shadowed by what's happening in the US. So at the beginning of April, we had the governor of the Bank of Canada come out with Deputy Governor Caroline Rogers. We talked about this realm of a possibility of a cut, and obviously that should have moved the market here in Canada, some of these bonds, and obviously the sentiment in the market to sort of see these yields drop off. But it is 100% shadowed by the data in the US. And I think that's something that we've advocated on this channel many, many times. So if we just really quickly turn our attention over to the US, it's really important to understand why the US is in a different position, and that is really going to impact the Canadian fixed rate mortgage. And when we think about their unemployment rate going down, their job numbers going up, they have, unfortunately, a problem with inflation. They haven't seemed to get it under control. And for the last 3 consecutive months, they've seen inflation tick back up. So it's actually accelerated in the US. Their super core numbers are starting to go back up as well. And I guess I would sort of correlate that, or if I had to draw a parallel, that would be like looking at our Canadian CPI core, medium, and trim. And here in Canada, those numbers are starting to pull back. In the US, they're accelerating. So you have that sentiment, you have consumer spending going up, and many economists, like, for example, Steve Eisman, who's better known as the character in The Big Short, played by Steve Carell, he's coming out saying, we have to watch what happens next, right? So this individual, he came to notoriety because of the fact that he was able to pick off the CDO, the collateral debt obligations of the US that caused the onset of the great financial crisis, right? So if you prescribe to his economic outlook, he's saying The US should not be making a move right now. The biggest thing that they should be doing is just standing still and monitoring the situation, sort of like we talked about in Canada for some time.
In kind of an interesting environment where we're definitely worried that the economy, for Fed reasons and for Fed cut reasons, we're worried that the economy is staying strong and that inflation.
I think it's more than staying strong. It's actually, I think there's been a reacceleration.
But we're also worried
Right.
that there's going to be a recession because the Fed is going to have to engender one to tame it. So we're worried about the economy's too strong and there might be a recession. So
everybody's hoping for a little bear's porridge.
Exactly.
Right.
Something just right. Because
Right.
we're worried. And has that ever happened? Can we really orchestrate that?
Yeah, we have it right now. Everybody should just relax. When Powell said, I think it was last week, it feels like an eternity ago, that financial conditions are tight. I was like, what planet are you on? So, my view is the economy's fine. There should be, I personally think there should be no Fed cuts this year. And, the market will do whatever the market does, but the economy's fine. Things are good. The Fed should do nothing and wait for data to get weak. Because there's no weak data.
And he's saying if we were to see the US Fed, Jerome Powell, cut rates prematurely, well, that's going to introduce, obviously, cheaper money into the economy in an economy that's already running on all cylinders pretty much. We see productivity, infrastructure, a lot of development happening in the US. That's going to introduce cheaper money. That's going to continue to stoke inflation, pull things up, and ultimately instead of having things come down. And the conversation is that there might be a need for a hike.
My actual fear is that if the Fed were actually to cut rates, the market goes into it becomes, I guess, bubblicious. And then we have a real problem. Not that anybody ever calls me, but, I would just do nothing. Why would you do something when the economy is fine?
You don't think we need to raise?
No, I don't. But actually, my fear is that if they cut,
we'd have
then eventually we'll actually have to raise. That would be the worst possible thing that could possibly happen. So, one of the things I've learned as a portfolio manager is maybe the hardest thing to do as a PM is to do nothing. Because it's so easy to actually do something. And it's the same thing with the Fed. It's so easy to do something. They could cut whenever they want to cut. The hardest thing to do is just to sit back and say, okay, everything's fine. Let's just sit and wait. And if things get a little weak, then we can cut.
So why are we focused on the US right now? Because ultimately, if we look back at the beginning of January, there was a conversation around the US cutting maybe 5 to 6 times. And we saw that conversation sort of echoed here in the Canadian sentiment. Ultimately, that moves markets, right? If we start to get this inclination, hey, things are going to change, we're going to see rate cut, well, things start getting priced in and bond prices move. But ultimately, now that that sentiment is now being pulled back, we're starting to see the ramifications of that, both within the economy, within the stock market. We're starting to see all these things play out. And that's taking away all the geopolitical issues, like the things that are happening in the Middle East, and obviously looking at oil. We're talking about the fundamentals of an economy, not the other geopolitical issues that many have little control over, arguably, but ultimately the fundamentals, what's happening with employment. So if the US doesn't cut, that ultimately pushes bond yields up here in Canada, which triggers fixed rate mortgages to go up. And ultimately, this is where we are at the current moment. Obviously, there's more nuances in this. I'm trying to simplify it as best as possible because that is a good way for a lot of Canadians that are coming to me saying, and how do we sort of figure out what's going to happen with fixed rates? What are some of the catalysts for this? And I'm saying, look, there's many things you can look at. One of the major leading indicators is what's happening in the US. So if you really want to pay close attention to sort of the sentiment that's happening in the US, if we start to get that conversation reignited in the US where, 1, 2, 3 rate cuts, when are they going to come? Then that could move the market over here in Canada. But ultimately that conversation has shifted even here in Canada. And yes, we have that realm of a possibility of a cut coming in potentially June or July. I do firmly believe now I'm changing my opinion and my thesis as the data continues to roll out. I mean, ultimately, if we see weaker inflation numbers in Canada, the data continues to come in worse. Well, that's better for the Bank of Canada to open that door for that cut a little bit sooner. And they will have to cut ahead of the US. They will have no choice. Even though they will be importing inflation, yes, the US exchange, yeah. The ultimate point is that the Canadian economy is probably most likely right now in a recession. And we won't really know that. Usually that number doesn't come until we look back at the numbers and we actually see those levels. But growth, definitely at the weakest point in a long time, even though it's forecasted to go up. We have unemployment ticking up. We have less jobs being created, higher levels of immigration. the story is definitely a mess, especially when it comes to housing, all this deficit spending. I mean, that will be the only thing that we'll pay close attention to in June when the Bank of Canada meets to see if there's enough data there for them to move the needle or continue this conversation. So that is ultimately something that comes into play. Now, when we look at the housing front, we talked about June 25th, capital gains conversation at 250,000. Just as a quick refresher, obviously we're not an accountant, so I can't tell you how it's going to get calculated for you individually. So if you do have an accountant, speak to them. Now, there's a big difference when you're in a corporation. If you're incorporated, then there's no $250,000 inclusion. It starts at capital gain $1. So this is a big problem, as it's really starting to spark a lot of conversation amongst the middle class, small businesses, doctors. Doctors is a big one because they're pretty much in corporations, right? Doctors form their corporation, they're paid into their corporation. You can argue if doctors are, wealthy, if they're the ultra wealthy. I mean, this is not the point. The point is the bigger picture, right? If you're going to take all these doctors that we desperately need in Canada with our healthcare system failing every single day, then to train them and then have them move to a different country like the US. Now, it's important to note that there is a proposal for the Biden administration to increase the capital gains tax in the US as well. So this is something that's sort of coinciding. As these governments continue to spend trillions and trillions of dollars of deficit spending, they have to make up the money somewhere. And for some reason, they always think that the best way to get that money is through taxing the wealthy, but there are unintended consequences, especially when we look at the US and the business sentiment. I mean, this is where the US sort of accelerates, right? Magnificent Seven, you look at the infrastructure, you look at them building out. Some of the best companies in the world are American based. So, if you stifle that, what happens to your economy, jobs, yada, 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 right? This is the dollar question. So I think the US was around 25% capital gains. Now they want to bring it up to around 45. And in Canada, it was at 50%, now going up to 66.6%, 2/3. This is the $1 million question when it comes to investments, okay? So aside from the business part of it, ultimately that's one conversation. And I do believe that is something that, if it does pass the House, that's I think the most important thing. If it passes, if this budget gets passed into act, then we have to really think about it. But as we get there, and most Canadians do believe that this budget unfortunately will pass, and unfortunately or unfortunately, depending on what side of the aisle you're on, I think the NDP will support the Liberals in this budget because they have been always on the platform to tax the wealthy. So chances are it will pass. And that has now led to many Canadians saying, okay, well, I'm a small investor. I have a condo. I bought it 10 years ago. Now there's this huge capital gains implication for me. So we might unload it because it can actually keep some more money in my pocket. So it might be moving Canadians that were not previously thinking about selling their investment properties. Maybe those who were able to adequately support them because they bought them a long time ago. Cottages, those individuals with the transfer of property from a family cottage that you've had in the family for so long, and it goes to the next survivor, it goes next to the child, the kids. You're going to get hit with capital gains after June 25th. So this is really causing some pandemonium in the market. Now the question is, will we see a huge amount of inventory hit the market? And I'm not saying that there is a correlation here, but builders and developers, we hear 60 projects being delayed. We see housing starts at the lowest levels that they've been. And ultimately, there's something really within these numbers that we should be paying close attention to. What those things are, I have not yet, it has not come to me yet. And ultimately, that's why we're doing these channels, so we can get some feedback from our viewers. But we have less homes being built. We have a government that's saying, hey, we need to build close to 4 million homes by 2031. How is that going to happen? I mean, how is that going to happen? Are they depending on this tax to maybe sort of push investors to bring all this inventory to the market? And, within the next less than 60 days, is it going to push all these inventory or this inventory into the market? And who's going to buy it? Especially as there's a lot of people that are maybe still on the sidelines as things begin to change. We wait for the Bank of Canada. Maybe, June 5th, they come out, they say, hey, rates are coming down. Maybe a lot of these people will buy, but the question is, will they close before June 25th? And what happens on the other side of June 25th, I think, is a really important question, because those who don't unload, well, we could definitely see a stagnation in inventory hitting the market, especially with investment properties, because then at that point, the new tax may be in effect. and there's no point. They're just going to refinance. Investors are going to pull out. Now, the reason why that's important is because if you have investment properties and you're holding them in a corporation, remember, you get taxed on capital gain $1. There's no $250,000 leeway there. So ultimately, this is going to be a really important question. This is going to be a really interesting conversation. We will definitely be talking about it more on the channel as we start to get this data roll out. Will we see more inventory hit the market before June 25th or not? Let me know in the comments section below. And ultimately, do you agree? Do you think that the U.S. economy is the leading indicator for Canadian fixed rate mortgages? And will you be tracking that? Let me know in the comment sections below what you think. But we'll leave the video here. We're wishing everyone a wonderful Friday. Don't forget to subscribe, and we'll see you next week. Thanks for stopping by.